This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I am your host, Scott Meyers, and this week's guest is Levi Brackman. Levi is the CEO and founder of Inbound, an SEC-registered marketplace where sponsors can raise an unlimited amount of capital from anyone, up to and including from non-accredited investors. Now, Levi has been investing in real estate for 17 years, and he is also a serial entrepreneur, best-selling author, PhD in the quantitative social sciences, and a former executive at major tech companies. Levi also holds a master's degree from the University College in London. And Levi and I met at the Family Offices event down in Florida recently. He's got an incredible opportunity for those of us that are sponsors, syndicators, raising capital for our projects. That I just had to have him on the show and talk about this incredible opportunity, and maybe new to just about everybody on here. But with that, Levi, welcome to the show.
Thank you so much for having me, Scott. Appreciate being here.
Yeah, my pleasure. My pleasure. So I wanted to turn on the cameras, turn on the microphones, and just continue the conversation that we had in Florida for everybody to learn about how, what on the surface it sounds like, and what is probably going through everybody's mind, it sounds like we're combining a Reg C, a 506C, and a 506B together, both accredited and non-accredited investors. And that's sort of what we're trying to achieve here as well. But why don't you go through the intricacies of what this looks like and what a Reg D 506CF can do for our folks?
Right. Well, it seems that way to a lot of people. It's interesting because I've actually gotten people send me queries and ask me, hey, is this, so I want to talk about doing this 506B and 506C together on your platform. And the truth is that legally, you cannot do a 506C and a 506B together if you're using those exemptions. So we can kind of go all the way back, because a lot of people don't realize that what we're talking about is securities law. And a lot of like real estate people, they're like, oh, I have a securities attorney, and they worry about all of that, and I don't need to know anything about it. And the truth is, the more knowledge you have, the better off you're going to be. And securities law is not as complicated as people make it out to be. There are a few basics that you need to know, and the rest kind of fills in around it. And I think like securities lawyers very often want to keep it as opaque as possible, because that's how they make their money. I am not an attorney, but I have spent a lot of time immersed in securities law. So if you go back to what a security is really an instrument through which other people invest money in a business. And there are a number of things that need to happen for it to be called a security. And number one is that it needs to be an investment in a joint enterprise. So it needs to be in a business or something like a business, where the expectation of profit comes about as a result of the efforts of other people. So that means you're an LP, right? You're not a GP in the deal. You're an LP. And as long as you're an LP in that deal, then you are investing in a joint enterprise where you expect the profits don't come about as a result of your work, but as a result of other people's work. And then if that's what you're doing and you're investing in that joint enterprise, then you're buying securities in that enterprise. Now, whenever you buy securities laws come into play. And the rule is that you have to, if you sell securities, you have to first register them with the Securities and Exchange Commission. That's the rule, unless you use an exception to that rule. And the exception to those rules have different names, which really refer to the chapter and verse in the law where that exception is written. So there's a Reg D, that's Regulation D in the law, which is the Jobs Act, which and then there's a Reg A, and then there's a Reg CF, and these are all related to exemptions. Within Reg D, there's actually two categories. Category 1, 506C, which is a newer one, and then there's 506B, which is an older one. 506B was always known as a private placement. Private placement, you go around, you find private people who can, place large sums of capitals in your deal, and then you don't need to register it if you're doing it. Just private people, you go into them privately, you're not doing any kind of promotion. 506C is a new law, came into effect, I think, 2012, which says you can actually do promotion. So it's called general solicitation. So you can solicit, but people who invest need to be accredited. Now, these two, they basically contradict each other, 506B and 506C. So you can't do them together. So a lot of people will start out at 506C, which allows you to accept 35 non-accredited investors and then stop that and then go into their 506C, which allows them only to accredited investors. And that can be clunky for many reasons, but it also means that you can only allow 35 non-accredited investors and you can't do any kind of promotion to those people. Then you have a Reg A, which allows you to raise up to $75 million, and that's from anybody, but it has to be registered with the SEC. So it has to go through registration process. It's kind of a mini IPO. And that, takes about 6 months with the SEC. You'll need to spend up to $100,000 in legal fees to get that. And then you'll need a tech platform through which to kind of get the money. And then in the middle of those two is this thing called a Reg CF. And a Reg CF was originally made only for people, it was $1 million a year that you could raise just for a startup, basically. You want to start your new restaurant, your new tech company, your new, a car dealership, you name it, you could go and you could raise up to $1 million from the public. So for a long time, that wasn't that relevant to real estate because $1 million just wasn't enough money. That went up to $5 million a year in 2021. And what that means is that you can raise up to $5 million from the general public, and you can do general solicitation. In other words, you can promote it, as long as, and this is the caveat, that it's done through a funding portal. So you have to find a third-party funding portal which can host your raise, and then you can do the promotion. Invone, my company, is a funding portal. The nice thing, though, is that you can do a Reg CF and a 506C concurrently. And what that means is that you have one page, for example, on Invone, which is the funding portal. And if you're an accredited investor and you want to also prove that you're accredited, you go into the 506C funnel. So all through the same page, the customers or the investors have the same customer experience. If you're not accredited, then you go to the Reg CF funnel, and so basically behind the scenes, you've got two escrow accounts, one for your 506C, one for your Reg CF. The actual client or the actual investor doesn't feel the difference. They're just asked a series of questions, and depending on how they answer the questions is how their money is funneled in. But therefore, you can raise an unlimited amount of capital. You can leave, because on a 506C, you can raise as much as you want, and your 5 million is capped for the accredited, non-accredited investors on your Reg CF. So we provide for both of those. And the key problem we're trying to solve here for sponsors is that if you're doing a 506C, you're spending a lot of money probably on promotion and on advertising. But only 13% of the population, according to the SEC, are accredited. So everyone's seeing it, but then someone shows up and says, hey, I would like to invest. And you say, hey, show me your credentials. And if they can't show it, or they don't want to show it, then you have to tell them, I'm sorry, you can't come in. That's leaving marketing dollars on the table. This kind of solves this for you and allows you to allow anyone who wants to come into the deal. And, the minimum investment size, that's up to you. We have on our platform anywhere from $500 to $25,000 as minimum investment sizes of people doing Reg CFs.
So that's first of all, that's an interesting piece. I don't know that I've ever paid attention or looked to, Levi, that only 13% of the population is accredited. And I'm not debating that number, only to say in the context of the way you placed it, when you set up your marketing program and you're spending your marketing dollars, it blankets an audience that you have, and we don't know what percentage of that data set is accredited or not. And I guess, well, of course, Storage Nation here on this podcast and most of the folks that pay attention to anything that we're doing, I imagine that number is a little bit higher. But at the end of the day, there's marketing dollars that are being wasted. And if we can capture some of those within that, then obviously that makes sense. And also for myself, and I imagine there's some other sponsors out there as well that, Perhaps we started with 506Bs just because it was the true friends and family, some people that came along. And I can tell you that 13% of my family and my friends aren't in that boat where they're all accredited. And so to be able to raise capital that way, because they know, like, and trust us, that's usually the way that people get started. And then they kind of gravitate over towards the 506C. Well, those folks that invested with us in the past, if we've sold off of that property or the project and then they can't get into the next one, well, they may be feeling left out. And, we would like the ability to get them involved because we have a pool of investors that we could round out the capital stack with and keep them involved and keep them engaged. And so, I don't want to say the best of both worlds, but it's truly a win-win for syndicators who are gravitating and as we progress in our investing career. What is that kind of what you're seeing, or what would you add to that?
So I'm seeing exactly that. This is a real problem that syndicators who are looking to promote to their deals face. And they want to solve this problem. As a matter of fact, it's even people who are not promoting so much, but I spoke to someone at the family office conference who told me that he's got a bunch of investors who just don't want to show their accreditation. They're not interested in showing their documents to anyone. So it's not just, well, then I'm sorry, dude, you can't come in. But what do you mean? There's trust funds people who've got tons of money in their trust funds, but they don't want to show that to anybody for whatever reason. They're very private. And so that's another way in which you can kind of solve that problem. But then there are plenty of people. Look, it's about a $5,000 to $6,000 customer acquisition cost for every new accredited investor you get. So if you're doing promotion and you want to raise money from accredited investors, yes, you're right. You could have your audience who sees that marketing of yours to be, higher in percentage of accredited investors, but it's you and everybody else who's marketing to those people. So for you to acquire one of those, it's about $5,000 to $6,000 in marketing spend before you've acquired one. Now, that's fine if you can if you figured out your numbers that works for you. But there are non-accredited investors who can write out $50,000 checks. They have IRAs. And they have money in their IRAs, and a lot of them want to invest or be exposed to multifamily or to self-storage or to other types of real estate, and they don't have access to that through REITs. So they have their self-directed IRA. They're going to put $200,000-$300,000 into it, and now they want to put that into real estate. Well, you've basically locked those people out by only doing a 506c.
So another piece of this, I mean, obviously the key to this is the portal. So maybe a follow-up question: do you market other projects to the folks that are in the portal, or is that permission based? In other words, if there's other sponsors, is there another open community within the portal of folks that are here to learn about not only the opportunity from the sponsor that they know, like, and trust, but can they go and shop for other investments on your portal that they can put in front of them because they are offered by other sponsors?
Yeah, this is actually both so I'm here to educate your audience rather than just to sell what we're doing. So I'm gonna give you the lay of the land here with Reg CF. So if you are a sponsor and you would like to do a Reg CF, and I've heard this feedback from sponsors that they don't want anyone else who they drive traffic to their page to see another deal, and that's a fair thing which you feel, and I'll tell you the counter argument to that in a minute. But there are options. So there are companies which should just provide you the technology, and so now you've got the technology, and then you contract with another broker dealer, because broker dealers can also do Reg CF. So you contract with the broker dealer, and the broker dealer so you've got the technology provider, which will white label you a page to enable you to kind of bring in the money, put all your information about the deal, investors come in, and then you've got a broker dealer on the back end, which then basically sets up your escrow account and all that kind of thing to make sure that you're totally compliant. Because it can't just be an InvestNext, right? Or one of those other companies. It has to actually have all the different compliance pieces related to Reg CF. In other words, there are rules associated with it, which the SEC and FINRA allow. So, and most of the regular investing portals don't have that. So they have to have it all built in with all the different. There's ways in which you have to be able to offer a refund within 48 hours of closing. There are specific disclosures which need to be there. There are specific types of notices which need to be sent out at specific times. All those things need to be built into the platform. So you'll need one which has all that information in it. They'll charge you a technology fee. Usually the technology fee is somewhere around $25,000 or more. Then you're going to pay the broker-dealer fee. And the broker-dealer fee is they usually take about 8% of capital no matter what. So you can do that, and you'll get your own white label thing. And if one just goes to your page and it looks like it's just your brand. We do it differently. We're trying to create a marketplace. It's a bit like if you want to go and buy jewelry, where would you go? You go to 47th Street in New York, right? Or Hatton Garden in London. Why? That's, if you want a really good jewelry store, that's where you put your jewelry store. If you want to have, if you're Louis Vuitton, right? You're going to go into in Hollywood, or not in Hollywood, what's it, Rodeo Drive, and you're going to have a store there. right? Despite the fact that you can have the competition. So we're trying to build like the Rodeo Drive or the Hatton Garden or the 47th Street of real estate investing. So that's why we think you should come to us, because everyone's going to come to us eventually. This is going to be top of funnel. So that's what we're trying to build. So yeah, you'd come to us. So true this, but a possibility that people will see other deals, but you're driving them to your page on our platform. You're not driving them to the homepage, not to the front page. You're driving traffic to that page with your deal on it. Now, they could look around and find other deals, true, but that just means that they're in good company. It brings greater credibility to you. But I certainly hear the argument which says, I don't want anyone to see any other deals, as if they're not looking around the internet for other deals anyway. I mean, but but if you want it now, our fees are way lower than you will find if you want to go with your own white label page. And the reason for that is because, we built into this concept that we're building a marketplace. And therefore we will lower our fees because we don't need to just make our money on you, right? We're going to, as we build a marketplace and you build a network effect, everyone benefits eventually.
Well, I typically come from an abundance mindset anyways, Levi, and that is, but especially in this instance, in this our argument, if you want to call it that, or debate on both sides, and of course you want to protect your folks, but by the same token, as you just said, they're looking, if you don't have an investment to put in front of them, or if they don't like the one that you have currently, they got some money that needs to be put to work, they're going to go find a place. So you should, as a sponsor, as a syndicator, then refer them to somebody or a place where they can get a good investment, because then you've at least kept them in your inner circle. You've, instead of sending them out where they may never come back or let them find it on their own, at least you have a reason to keep in touch with them. And if you provide a good investment for them, then, they will look at you as a trusted advisor, and it elevates you to an even further position of trust, rather than just saying, well, I don't have anything, but don't go anywhere else. Just sit on cash until I got another one that comes up maybe in 60 days from now. So I never think that that's a good approach. So I'm 100% on board. So let's talk about the growth that you're seeing as a result of, folks pulling out of Wall Street. I mean, a portion of what you do and exactly what we do is educate folks, and then it's showing them and introducing them to other investments, other ways to invest in, bolt-ons from sponsors to passive investors as well. Tell me what you're seeing out there where these folks are pulling out of Wall Street and they're sitting in cash right now. How are you able to then provide or show them that this is another way to be able to put their dollars at work? And is that a big push of yours, or is that just a draw from the sponsors and other folks that you work with?
Yeah, so it's interesting. Like, there's a few things which are very clear to me, like I have absolute conviction on, right? Number one, and primarily, is that and this is borne out by the data as well. In the last 3 of the last 4 years where they've done surveys, every year there's surveys which ask Americans what they think are the best investments. Is it the stock market? Is it keeping it in cash? Is it real estate? 3 of the last 4 years, except for 1 year in COVID, right? Americans have said that they think real estate is a better investment than the stock market or cash or crypto. Right, so Americans consistently think that real estate is the best form of investment. So that's true out there. Now, the fact is that it's hard for them to get into real estate. Those barriers are coming down. And the way they're coming down is by some sponsors, and they call themselves tech companies, but they're really sponsors getting creative and doing Reg A's and suggesting as if people can invest, deal by deal. Our belief is that what we need to do is level the playing field by allowing all sponsors to reach that mass of the public which wants to invest in real estate and do it on their terms. So you have companies which have one-sided platforms, if you like, where they buy the real estate and then they kind of fractionalize it and sell them off to the public. So they're the only sponsor, really. But what we want to do is just facilitate it for sponsors. Any sponsor who wants to come in and wants to offer directly to the public, we want to facilitate that. And what we're finding, again, just to answer your question directly, is that we are a B2B2C company. So in other words, we are not the ones who go directly to the end consumer. It is, we enable the sponsor to go direct to the end consumer, and they couldn't do that on their own without us or without someone like us, because it wouldn't be legal for them. So we are a B2B2C company. So that last bit of 2C is something which the sponsor does 2C, right? But what we're finding when we talk to sponsors are that some of the bigger players, the bigger family offices, the private equity firms, et cetera, who were giving a lot of money in the past to deals have now pulled back. So, fair weather friends. So you want to diversify your investment, your investor base right now. And now is a good time to kind of build that brand. And a lot of sponsors who see this and understand where the trend's going, especially younger guys, right? They see this and they understand that in the future, if you build your brand with retail investors, you're going to have a lot of money, which is consistent. And every year, all these guys in their 401k, you become part of their investment strategy and you start returning money to them. This is going to pay dividends to you well into the future, deal after deal after deal. They become your guys if you build the brand. And those are the people who we're seeing really going heavily into this because they understand that the money's there, the desire to invest is there. They just need the conduit, and we're the conduit.
Perfect. Well, you heard it, folks. For those of you that, whether you're young in age or young in your investment career and you're looking to raise capital and grow and scale the business, which I think many folks here fall into that bucket, then it is all about the brand. You're right. I'm glad you touched on that, Levi, because the folks that are just putting out what they feel is a fantastic deal and it's a really sexy project and it looks great and the slick is great and the photos look like better than Airbnbs and you've promised some unrealistic projections and an IRR to attract folks, well, it's not going to take long before you don't return those and the deal doesn't perform as well as your projections. And that is not the brand that you want because in today's world of social media transparency, you're not going to last very long. And so under promise, over deliver is always best. And if you have, nobody wants to go, this is like dating and marriage and nobody wants to go out and try to date other investors and, go through a deal with them to know, like, and, to learn that they can, like and trust this person to invest with them again. They want to attach themselves and hitch their wagon to one guy, one gal, one company, or maybe a couple that they can go to over and over again when they have, as you just mentioned, Levi, they got another 50,000 or 100,000 that has come in from somewhere else, or they got access to a 401k they didn't before, inheritance or anything else. They don't want to have to go out and do all the research again and then, go through the dating process. So that is a very, very wise, good words of wisdom. So what else, you've been at this game for a while, Levi, you've seen lots of things. Your resume is very strong from an investor mindset. What are some of the other things that we should be mindful of? Maybe some blind spots that are some gotchas or just some carrots that we can put in front of folks to make our offerings stronger and to build up that trust campaign and put ourselves in the best light and the best position to raise as much as we possibly can during this next phase.
Yeah, you touched upon something which is like really, really important and shouldn't be glossed over. And I want to just reiterate. And that is that people think, and I've heard this that from like marketers for real estate deals, that, you have to put a really attractive IRR. As a matter of fact, the SEC and FINRA don't like the idea of IRR at all. And so when you said, under promise, over deliver, well, don't promise at all, I would say, because you can talk about your past record if you have evidence for it. So definitely talk about that if you have a record and say, hey, in the past, we've delivered X, Y, and Z. But if you're making a promise for the future, you can get yourself into real trouble. You need to really, really not realize that the retail investor might not know that much, but don't play to that as your advantage and therefore their disadvantage, right? Just be straight up with them as possible. And that will be to your advantage long term. And also you won't get in trouble, right? Because so just be very careful that, don't be promissory and try not, and just try and be as clear as possible about what the risks are and don't try and hide them. And, most people understand it's real estate. They understand, things can go bad and things can go well, and it's a risk. But don't overpromise. So that's a really, really important thing.
And for clarification, wrong verbiage because we don't promise anything. That's they're projections, but putting out a high IRR, higher than what most. We're all in this money game together. Meaning, those of us that are sponsors, whether we're in the multifamily asset class, mobile homes, assisted living, self-storage, we're in the money game. We're a financial services company that deploys capital backed by real estate, and we choose self-storage. And so we're all looking at interest rates and returns out there. And so is it an 8 pref, a 10 pref, a 12 pref? Is the IRR over 4 years or 5 years, 17, 18, 19? Is it a development project? So it's a little riskier, a little higher IRR, a little lower, but we're all in that same range because we're competing for the money pool of folks that have to invest. And so when there's folks, or I see projects that come out and it's a 12 pref and they're promising a 30% IRR. First of all, you need to certainly take a look under the hood and understand what is their track record. Have they returned over 30% to the investors? Have they even exited? Have they gone full cycle on their investments? How many? And where were those IRRs? And more importantly, what is the delta between the projected IRR and the actuals? Did they meet it? Did they exceed it? So that you get an understanding of what these folks look like. But more importantly, we want to be very competitive, Levi, but I think, what we tell our investors, if they say, well, I saw a project out there where I can get this IRR or that, I say, well, all right, if it's a development project or a lease up or value add, which it has to be to get that value add, they're borrowing more money from you in order to cycle that money back to them in the meantime until it becomes profitable on an exit when you sell it. And all that does is stress and burden the project. You're all in it for the big payday at the end. And yes, you're getting paid, a pref or a coupon, if you will, until you get to that place. But all they're doing is recycling your money, and they're overburdening the project because of the time value of money and the interest that is on it. So, and that explanation, that argument doesn't always win, but at least it gets people thinking. But it's a true statement. I could put out anything I want in terms of a high IRR in order to attract more folks and to maybe fill up my projects faster. But I don't know that puts more stress on me to perform because I've overburdened the project. Am I making sense?
Yeah, absolutely. And if you actually list on Invone, we will recommend very strongly not to have an IRR at all.
Nothing. So you're looking at time frames and either a range, or what are folks looking at?
You can put a range. Put a range. Put your past performance on there, right? Mm-hmm. Put the numbers, right? Yep. Explain what the numbers are. But like an IRR, it takes into account so many things which could happen in the future that the SEC and FINRA consider it to be promissory. So I think, Grant Cardone got in trouble for using IRRs. Right? I think that people are going to realize more and more that it's actually a business risk to put out an IRR because the SEC don't like it. FINRA doesn't like it. And it's going to be a business risk because it just has to be one person or one group or one attorney come along and do a class action lawsuit against a couple of sponsors that no one's going to do it anymore. So I would say to sponsors who listen to it, try and find a way in which you can kind of show the differentiation of your deal based on real data, not on the rosiest projections. And those are going to be the best deals. And play the long game, because in the end of the day, investors are going to respect you for that, and they're going to say, I know this guy, he's giving it to me straight, because when people come and they say they race for the top IRR, it's just an ignorance. You're playing on people's ignorance because smart people know that IRR doesn't mean much.
Well, how often do we hit it? I mean, every once in a while, if we're looking at a blind pool or a fund and we state in the operating agreement that we're going to exit in 5 years, yeah, most likely we'll do that. But we also, in our operating agreements, those of us sponsors, we have the ability to hit the brakes or the gas at any time. We can exit out of an entire portfolio if interest rates and cap rates are low to maximize the IRR, and that's either a good number or not. Did we hit our equity multiple? Because if you exit early to boost your IRR, your equity multiple may be less. And so you promised a 2.05, IRR, or excuse me, equity multiple, and you only returned 1.78 because you sold early, but your IRR went through the roof. Well, there's going to be the contingent that says, hey, you returned less money to me than you said you would, because I expected a 2 times return on my money. I had 1.78. Now I understand I can roll my money again and get a greater return, but now I'm sitting on my money. I have to go out and find another sponsor, another project, and now my money's sitting in cash. And if it's not in a retirement vehicle, I've had to pay capital gains on it in a year in which I don't need to take those right now. So there's, you're right from multiple points that IRR, it's very subjective and it can be manipulated by so many things, but mostly when you exit the property, because we as sponsors, we're always going to be looking for the optimal time to exit it. And it may never even come close to what we set forth in the private placement, the PPM and in the operating agreement.
Yeah. So great point. You made it much better than I could. The idea here is that I think people, mostly investors, if you really ask them, what they really want to know is that their money is safe. A friend of mine told me that rule number one, don't lose my effing money. Right.
And return of
so
principal.
If they trust, and if they trust, they trust that you're going to actually care for their money and do what's best for them and have their best interest in mind, and not take excessive risk, then I think that is the kind of investment that people want. Now, if people truly understood that the high IRRs, which are being suggested, they're just suggestions, nothing more, nothing less, then I don't think they would hold as much water. Unfortunately, it's being marketed as differently. And I think a lot of sponsors are now calling it target IRRs, and they're putting in ranges. And I think that's a better way of looking at it, putting in a range and make it very clear. If you see on our platform, it says very clearly, they're never promised, these are just projected. And then it says, look at the risks and disclosures. And then in the risks of disclosures, when you go to the first thing it says is you could lose all of your money.
Correct. Yeah, we moved over to that when we changed our attorneys recently, and recently within the past 2 years, and that's exactly what we do. Our ranges of IRRs is 3 points, and it says target, exactly just as you said. And there's a reason why these private placements, it takes 10 pages to explain the deal, and then the other 78 pages to talk about the risk and what could possibly happen, including a zombie apocalypse in which we could lose everything, and the Earth is thrown off its polarity, and we lose power and all over the globe, all of it. And every other kind of lawsuit that has come before that, that can be a reason for it as well. And so, disclosures are just a natural part of it, and that is there as well. But it's those first 10 to 12 pages in which you claim on the very first page, here is your target IRR, and it is a range. Ours is 3 points right now. So, very good stuff. All right, so we've talked on, and we could talk about the nuances.
I want to point out one quick thing. I'm not an attorney, so nothing I've said here is any kind of legal advice. You just asked my opinion, what I've seen out there, and that's all it is. Take it for that and not as any kind of legal advice, please. Yeah, there is no advice being given here, Levi. We make that very clear to everybody. We're sharing experiences, and it doesn't mean that it's right. And so disclose, as well as make sure that you hire an attorney before you transact any real estate transaction, period. And so thank you for stating that again. That is on the front of our podcast and is on the labels and everything else, but always good to disclose. So there is an art and science to this, and then the legal side to it as well. And we're balancing all of that. We need to persuade people, or at least show them that there is a better way than sitting in cash or other ways to be able to, invest if they so choose, to invest in real estate in a syndication, because they can see it, they can touch it, feel it. In almost all cases, they get equity in it. And so they understand that piece. They need to understand that the risks, that is the legal side to it. And then the math, does the math actually pencil out? And then the history, how well has this syndicator done? So it is not for the faint of heart. It is a full contact sport. But it's a beautiful thing. It is. I mean, when you nail this down and you actually do, it means you've got a good company. If you've got a strong company, you're investing well and you're making these returns to your investors. The proof is in the pudding, and that is what it's fun to tell that story then. So on the backside, when you can say, well, our projections over the past 15 years were 26% on average for all our projects, and we returned 34% to our investors. And so, yes, we didn't promise, we didn't underpromise and overdeliver, but here are our projections that we set, and we're fairly conservative in nature. And it's not just lip service or marketing, like, everybody says, every syndicator says that, but hey, proof's in the pudding. Here's what the math and the science says behind it. And so, to be able to balance that is key. And then to be able to, harness and the ability to bring on some folks without much risk, our unaccredited friends alongside with this vehicle as well, then, well, that just sweetens the pot even more so. So tell me some of the other blind spots, tell Storage Nation some of the other considerations as they head down this path of syndication, or doing this dual mode of bringing in unaccredited investors alongside of accredited, if you will, and how we bifurcate that, or just the nature of the market that we're in right now. What are some of the other blind spots you're seeing out there by folks that we need to be aware of? Yeah. So here's what I'd say. I sometimes, people hear this and they say, well, I've got a shortfall of $1 million I need to raise quickly. So let me just call Levi and talk to him, or Levi, and I'll talk to him, and Invo might be able to help me out. And the answer usually is I can't. And the reason for that is because this thing takes a little bit of time. So there's two things to be aware of. Number one is that we need to do our due diligence. Part of funding pool, we're registered with the SEC. Remember, FINRA is about to start the first year examination of us. So every email I send, they might even watch this podcast, right? So we're probably regulated by them. So, and we care about that. We care about what our role is, and our role is primarily to protect the end investor, to make sure that no fraud is going on. So we have to do our due diligence on the deal. We have to do background checks. We have to set up escrow accounts. It takes time. At least 30 days it's going to take from when you start talking to us till it goes live. And then it has to be live for 21 days, right? So the deal actually has to be live. And that's the law. It's not us. This is the law. It has to be live for 21 days. So you're talking about, if you've got a 30-day close that you need to raise money for, and you just started talking to us, we're not going to be able to help with your XCF raise. So just be aware that's a kind of a blind spot that people come, that if this is something you want to do, it should be part of your strategy, and start thinking about it at the very beginning of your project. So that's other blind spots. I think your audience, our sponsors really know what they're doing, right? So I mean, don't get emotional about real estate, but that's like anyone who's doing this professionally should know this. That's a blind spot, though. People do get emotional about it and they make mistakes.
Yeah, I would agree. And you shouldn't get emotional after you're already under contract. The time to look at this and not never get emotional or fall in love with the project isn't because you set a goal to have 3 deals done this year or 10 deals done this year, and you're on number 9. And so, well, this 10th one doesn't really look all that great, but you know what? I'll hit my goal. That is the wrong reason to do that, and we've seen that happen many times as well. So. And you're right, to your point as well, Levi, there's many folks that contact us. I mean, we do joint ventures, we do partnerships, we raise capital, we bring that, sometimes a balance sheet and some credibility to a lending package, a loan package that people bring us into their projects. But we're looked at many times as a life preserver. SOS, I'm X number of days from closing and I'm short. Scott, can you come in and just raise the capital? Well, the same as you, Levi, there's things that we need to do ahead of time. There's docs that need to be done and some marketing, and we need to warm up our folks, our investors, and educate them to a project, and we can't just do that. So I think being overzealous, or we as entrepreneurs, we're all a little more optimistic than I think we can be at times. We always feel as if everything's going to fall into place, but it is better to make sure that you feel as if you're going to oversubscribe any project in which you're raising capital, meaning you've got a pool of investors that you're not just going to try your list of people and hope and pray that it's going to happen, because hoping and praying is not a strategy for raising capital. And you could lose a deal and earnest money and have to give a bunch of money back and lose a lot of credibility in your community, meaning brokers, sellers, bankers, and that it only takes 1 or 2, failed projects that really never even got off the ground before it's going to be very difficult for you to do business. So I'll always be looking at the ability to transact and making sure that you've dotted I's and crossed T's before embarking on a transaction as well. So. All right, Levi, our time is coming to an end. This has been fantastic, and I can't wait to hear a follow-up once we have gotten down the road further, both you and I and the rest of Storage Nation here. But in the meantime, how do they find you? How do they get in touch with you to begin the process of working with you for the projects they got coming up this year?
So it's invown.com, INVOWN.com is a website. My email is levi@invown.com, and Levi is spelled like the genus Levi, actually. So it's Levi. My parents called me Levi and spelt it Levi. So it's confuses everyone, but that's what it is. So it's levi@invown.com, INVOWN. Invown is actually made up of 2 words. Invest, INV is invest, and own. So investors and owners is like the marketplace of investors and owners. So invown.com, and that's if you mention Storage Nation and the Self Storage Podcast when you reach out to me, then I'll give you a little bit of a better deal.
Fantastic. Appreciate that, Levi, and I appreciate you and taking time out. This is the second time this week that we've had lengthy conversations about what it is that you do and how we're going to begin working together. So I just appreciate you opening up again to talk with Storage Nation here. And guys, reach out. This is an incredible piece to be able to add on and get you across the finish line on some of your projects, and can be included on any one of them. So with that, Levi, any other words of wisdom or parting thoughts for the folks on the podcast today?
I'm just really, really grateful to you, Scott, for having me on, and to anyone who's still listening. Appreciate you still listening to me.
Of course they are. And thanks once again, Levi. So with that, for the rest of you, Storage Nation, we will catch you on the flip side. Thanks for tuning in once again. Take care. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.